Hi, I'm Cameron Hastings. I'm here with Brian, and today we're going to be talking about unanchored strip centers, which is one of the property types that we see as an emerging niche property type, as well as some of the historical analogs that have brought us to that point in our thesis.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Get ready for the Midwest Real Estate Investor Conference in Grand Rapids, Michigan. Join hundreds of real estate investors for networking, learning, and growth. Be sure to mark your calendars for April 24th and 25th of 2025. Hello and welcome to episode 487. The best investors don't just follow market trends. They see what's coming next. Cameron Hastings has spent his career advising institutional investors, private funds, and accredited investors on real estate portfolio strategy, managing over $1.2 billion in capital expenditures across office, industrial, retail, and lodging sectors. He's also played a key role in multifamily capital markets and ground-up development, bringing a rare blend of architecture, investment strategy, and market analysis to the table. Today, Cameron is here to share his insights on where real estate is heading, how to identify inflection points in the market, and why certain forgotten asset classes like unanchored strip centers may be the next big thing. Cameron, welcome to the show.
Brian, thanks so much for having me.
Tell us a little bit about yourself and your background.
I'm based in New York, where I've been for the last almost 15 years now. I started my career here as an architect, working for the firm Gensler. So as an architect, I started out designing law firm interiors, actually was my very first role within real estate or architecture, but I kind of quickly went into doing base buildings and renovations of office buildings. So that was typically working for developers, sometimes publicly traded REITs, sometimes private developers, as well as corporations that were using these as owner-occupied properties, so developing their own headquarters or developing one of their regional offices. While I was in that role, I designed close to 2 million square feet of office space in New York, LA, and DC. But what I realized in that process was I was really more interested in what my clients were doing, what the developers were doing, than what we were doing as architects. And that the scope of your role as an architect is much more limited than it seems from popular culture. That you're really not the one who's coming up with the concept for the whole project. And you're certainly not the one that gets to benefit from it once it's actually built. So realizing that from my work with my clients, I decided I wanted to go into real estate. I wanted to either go into development or some type of real estate investment, but I didn't exactly know what I was doing. My first couple of projects while I was still an architect were flipping houses. So I would take the bus from Manhattan over to New Jersey on nights and weekends after work and have these couple of projects I was working on, which worked relatively well. But I also realized I was competing directly against contractors who were the ones on the roof hammering the nails, hammering the shingles in. And so it was hard to compete on price. And I also didn't, while I had the fundamental understanding of how these buildings worked as physical objects, I didn't understand how they worked as businesses or as investments. So I realized that I had to go back and get those skills. So I went back to grad school. I got my master's in real estate development. And right after that, started working with a multifamily developer in Jersey City, which is just across the river from Manhattan. And they were at a point in their history, they were about 15 years old. They were at a point where they were transitioning their portfolio over from their legacy assets, where they'd either developed or acquired smaller scale properties. So 4 units to maybe 12 units were the bigger of their legacy properties, to much larger scale properties. So 200 units, 150 to 250 units was their new standard. So in that role, I learned a lot about hands-on development. I was responsible for some of their development projects, as well as beginning to think about a portfolio of properties rather than deal by deal or asset by asset. What does it mean to have this collection of properties? And in their case, they actually had, I think, 5 different properties on one block in Jersey City. So they kind of controlled that neighborhood. From there, I went on to work at Newmark, where I was a managing director focused on portfolio strategy. And that's where I really got the sense of the portfolio as the unit rather than just the individual property. So there I worked with similar types of clients as when I was an architect. So again, REITs, large scale private investors, as well as owner occupiers who were using those properties for their own uses. And that really ranged across the spectrum, like you said, from retail to industrial to office buildings to some medical type properties to even advanced manufacturing like electric vehicle batteries or data centers. So in that role, I got a full sense of the spectrum of real estate, property types, different geographies, how to be an operator at a national scale rather than just a specific to your market, and where the benefits of each of those are, whether you're a broader scale generalist or if you're much more focused on a specific property in a specific market. And then from there, after Newmark, the last couple of years, I've been working with individual investors, retail investors, as well as small funds and private firms on their own portfolio strategies. Now a partner with the Salim Brighthouse, which is a company that we launched about 6 to 9 months ago to focus on unanchored strip centers.
One of the things that I read in your bio is that you kind of are able to look at the market and see what is happening next. Where should you be focusing your attention on next? And I know we're going to talk about unanchored strip centers, but let's talk about that superpower for a moment, to be able to look out across all these different asset classes and say, this is where I'm heading. Do you feel that you have that superpower and that perspective? And what do you see when you look out across the horizon?
So one of the things that I do when I'm thinking about what could be next in real estate, and real estate has become such a diverse sector, much more diverse than it was thought to be 20, 30 years ago, where it was kind of multifamily office, industrial, retail. Now you could consider maybe 30 different property types, depending on how you segment all the different properties, especially considering digital infrastructure and things like that, cell towers or data centers that weren't really considered real estate, but now kind of firmly are considered real estate. So thinking about what may be coming next, I look to the recent past and see what's happened in other property types. So one of the large scale trends that's benefited property types like self-storage or single family rentals in the last 20 years or so is increasing institutional adoption of these property types. Some properties like multifamily.
I want to make sure we're clear on what you just said. Increasing institutional appetite for those asset classes.
Yeah.
So by that, you mean the big buyers have money that they want to spend in that area.
Yeah. So either REITs are starting to focus on these, large funds are starting to focus on these, or there's just a kind of a new need that owner occupiers are actually starting to build out these kind of new different property types. But yeah, when you start to see a lot of large scale money coming into a property type, especially if it's in a highly fragmented market where there isn't any dominant player, then it tends to be an opportunity for value creation, for cap rate compression, and to be able to create a certain scale of a portfolio that maybe didn't exist previously.
Give us some examples of that. I mean, I know you mentioned self-storage. Where have you seen that dynamic playing out in the recent past? Where do you see it playing out now? And then we'll talk about the unanchored strip centers, which I'm assuming you see it playing out now and in the future.
So the first one that in my lifetime has really happened is self-storage. So that happened starting around the 90s. Real estate went through a difficult period in the 90s, and those periods are often opportunities for this kind of new institutional adoption or consolidation or focus on a new property type. So before the early 90s, self-storage was typically these drive-up, single-level suburban type properties. There were some urban properties that had been converted to warehouses, but there wasn't much purpose-built self-storage in dense urban areas. But starting in that period where in the beginning of the 90s or late 80s, maybe 5% was owned by institutions, over the last 30 years or so, the property type has evolved to be these more purpose-built, dense urban pieces of property. And the ownership among institutions is now maybe 40%, half of all the properties in the country are owned by these institutions. So you went from something that, and this has to do with interest rates in general, but you went from something that was maybe trading at an 8-9 cap in the 80s or 90s to something that's competitive with the highest quality properties of any type, maybe trading in a 4 or 5% range for the best quality properties. So you see that kind of cap rate compression as these properties become more desirable to institutions and as they become just more widespread as well, that there's many more of them. Something that's happened in the last 15 years or so, a little more since the global financial crisis, is a similar pattern playing out in single family rentals. So we've always had single family houses You've always had people that owned a couple of houses and rented them out, or developers that built purpose-built communities, but typically they were for sale. You didn't have large-scale groups that owned thousands of single-family houses, especially disparate plots. But starting in 2008, 2009, when that market kind of collapsed, some innovative or entrepreneurial investors started to focus on those and said, well, we can buy all these houses for almost nothing. The banks are almost giving them away at that point. So that was when the institutional adoption of those property types started. I would say really in the mid 2000 teens. The early players were right after the GFC. Early teens to mid teens is when institutional players really started. And now you have portfolios with thousands and thousands, tens of thousands of houses in some cases by owners that are 10, $20 billion. I'm not sure where American Homes for Rent or Innovation Homes is right now, but these are huge corporations from a property type that not so long ago was not considered institutional quality.
And let's talk about what you see currently, which leads us into the unanchored strip centers. Explain what that is and why you're so interested in that area.
In terms of what they actually are, the strip center refers to generally the building shape. So they're these smaller scale retail properties, anywhere from 2 tenants, maybe up to 20 tenants before they kind of change into a different property type. But these are, depending on where you live, the properties that you see all over the place in your neighborhood. Typically suburban. We really don't have many here in New York, but in a place like California or Texas, where it's much more car dependent, Florida or throughout the Southeast, they're the main retail source for these local communities. The unanchored part refers to not having a national tenant or not having a big box space. So instead of having a grocery store or a Target and then a couple of inline stores, it's all inline. And the couple advantages there are one, about pricing. So you can buy these properties for much less than you can for properties that have an anchor tenant, where the credit quality is really considered a major advantage. But we see it a little bit differently in terms of the credit quality, and I'll talk to that in a moment. But the other advantage of unanchored centers versus the anchored centers with the large scale tenants is that us as a landlord, where we're a small company, if we're negotiating against Starbucks or Target or Home Depot, they have dozens and dozens of people that are negotiating against us. They have whole real estate departments, so that their entire job is to negotiate these leases. So it's hard to have an advantage when you're in those negotiations. If you're focusing more on smaller scale local tenants, especially ones who are more necessity based or ones who have more stable business lines, then you can have a little bit more negotiating leverage, especially if it's a type of business like a laundromat or something like that, where they've already put a lot of capital into the space in terms of all those machines, and it's the switching costs or the cost to move to a new location is quite high. So we see opportunity there just for the fundamental reasons around the tenants. But in terms of what the being analogous to self-storage or to single-family rentals, a similar thing is starting to happen with these properties. So these properties, again, just a few years ago, were considered too small or had too low credit quality among the tenants for institutional buyers to focus on. But just in the last year, in October, the first REIT went public. It was a spinoff of a more traditional shopping center REIT that is now just focusing on these unanchored, smaller scale centers. We also have a couple of large institutional players, JP Morgan and Nuveen, both have vehicles that are focused on these specific types of properties. They still focus on other types of shopping centers, and there's definitely merits to other types of retail. But we see a real opportunity here because of that early institutional adoption, the highly fragmented nature of ownership, where at the moment it's about 5% are owned by institutions, 95% owned by families or individuals. So the ability to assemble a portfolio where you're taking those disparate properties from those individuals or families that own maybe one or two of them, putting them together into a portfolio that you can then sell off to a larger player who, even though they are focusing on these smaller assets, really, it's not efficient for them to be buying a $2 million property at a time. They need to be spending $20, $30 million at a time. So the ability to consolidate these and sell them off to a larger player is part of the strategy. and similar to what we've seen in those other two property types I mentioned.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Save the date for the Midwest Real Estate Investor Conference happening April 24th and 25th of 2025 in Grand Rapids, Michigan. This event is the perfect place to connect with fellow real estate investors, gain valuable insights, and elevate your real estate game. With a lineup of expert speakers and numerous networking opportunities, you won't want to miss it. So it brings up a lot of questions. And first, I just want to address the perception that retail is dying because of Amazon. You know, the type of product that you're talking about is competing with Amazon in a lot of ways. But I'm sure you've had this conversation and had this question many times. So how do you answer that?
The retail landscape definitely has changed from the advent of Amazon. There was a period in the early 2010s when e-commerce really started going, and Amazon was very popular and started to have everything from just a couple of things that they had in the first part of the 2000s to this idea that we may not have stores at all, that everything may be happening online. And this term was coined the retail apocalypse, where maybe every retail property is going to be worthless because we're not going to have stores at all. What it's turned out is that still about 80% of purchases are happening in person. Around 20% are happening online. That's still shifting towards e-commerce, but it's shifting for specific goods and services. So it's not everything. There are just some things that you can't do online. You can't get your hair cut by Amazon. You can't get your nails done by Amazon. You can't go to the laundromat and it's happening online. So there's some things that just cannot happen online that are kind of e-commerce resistant for that fundamental reason. But then there are other businesses that are actually benefiting from this omni-channel approach where they're selling in person, but they're also selling online. And depending on which market it is or which specific type of business, it's very common to see when a new brand opens a physical location in a new market, their e-commerce sales in that market go up as well. So they're selling some in person, they're selling some online. So if you're doing it right as a business owner, the e-commerce aspect can actually augment your in-person business as well and kind of feed each other within that market. So we see opportunities where we're focusing on properties that have that e-commerce resistance, either, again, because they're physically not possible to do online, or because they're businesses that actually benefit from the omni-channel approach. There are some that are definitely don't have that advantage. So things like office supplies, bookstores, fast fashion, those are all much more focused online. Maybe 80% of those, especially something like fast fashion, is online. Maybe 20% is in person. So the inverse of the general formula. But in our strategy, if we can focus on those businesses that have durable business models, that it's hard to see how it could possibly go online, or again, like I said, has those kind of synergies with online, then the retail's property performance can still be quite strong.
Let's talk about the tenants themselves. How strong are they? I know when I think of retail, you want to think of the credit worthiness of your tenant. But if you're talking about smaller retail, maybe that's a little harder to prove and get the bank or the lenders happy with.
Yeah, so you don't have the credit ratings, you don't have the S&P, Moody's type of credit rating, but it doesn't mean that they don't have credit quality. Part of the way that you can determine that is just seeing how long they've been in these spaces and what their history in that particular space is. And that's one of the benefits of a value add type approach versus a development or opportunistic approach, is that you're buying a property that has a history of tenants. And some of these tenants have been there decades. We're looking at a property right now where there's a couple of tenants that have been there since the 90s. So seeing that kind of stability of their business model helps a lot, even if they don't have that kind of official seal of credit from a couple of rating agencies. But you also, when you think about the incentives among the small businesses versus the big businesses, a smaller tenant, this is their livelihood. This is how they're paying for their whole life, likely, how they're paying for their family. So staying in business is incredibly important to them. Whereas if you have say a Walgreens, or what we saw going through with Kroger or Albertsons, where they were talking about merging and closing hundreds of stores, for a big company like that, closing one location isn't a big deal at all. It may actually make them more money by closing the location because they're not having to pay the salaries, even if they're still paying rent. So the calculation about how much it would hurt the tenant for that location to close is very different between the two. Even if the credit quality multi-billion-dollar business has greater capacity to pay the rent, they have a lower incentive to pay the rent because their business is much more diversified. Whereas a local tenant, especially one that's been in place for a very long time, has a very high incentive to continue that business in that location.
Take us through one of your acquisitions. Like when you look at it, what's the criteria you're looking at? What's the plan you go in with to add value and get it ready to sell to the REITs or the end buyer, who eventually, it sounds like you would, that's your exit plan. I mean, kind of take us through the whole process there.
So when we're looking at properties, there needs to be a clear way that we can add value. There's a couple of ways that we can do that. One is if there's above market vacancy. So right now, about 95% occupancy across the country. Some markets are a little bit tighter, some are a little bit looser, but on average, most of these properties are pretty much at 95% occupancy. So if we can find properties that are, say, 85%, 80%, where there's enough occupancy that they're paying all their expenses, where we're not coming out of pocket to pay property taxes or other kind of maintenance issues, but there's this clear way to lease up that remaining 15, 20% and pretty much go straight to NOI, that's a clear way to do that. The other ways are where we see an opportunity to take a property that is physically in good shape in terms of the structure and the actual building systems, but isn't aesthetically appealing for one reason or another. Maybe has poor signage, so you can't really tell what it even is, what kind of businesses are there. Maybe it has poor lighting, so at night it doesn't feel safe, even if it is in a safe neighborhood. Maybe it doesn't have the kind of landscaping that competing properties have, so it just doesn't feel inviting. And there are a lot of simple things that you can do on these unanchored strip centers that range from just paint or new stucco, which is very inexpensive to do, to things like that better signage or landscaping that make the properties feel more inviting to come to, even if they haven't had a significant impact on the actual physical nature of the property. So we're generally not looking for heavy physical value add, more opportunities where we can improve the operations, maybe putting a new property manager in place, and where we can have opportunities to make the center feel better without significantly changing it.
And what kind of leases do these tenants usually have? Are they triple net leases where the tenant's paying all the bills, modified gross? What do you like to see? And when you negotiate new leases, what do you like to put in place?
So definitely when we're negotiating new leases, it's always going to be triple net. That's the ideal. Most properties that we see on the market that we're looking at and underwriting also have triple net. You do come across cases where there's gross or modified gross, which can be an opportunity that when that lease expires, even if you're not raising the base rent, just adding that recoveries in terms of the triple net recoveries to that rent, the tenant will be paying a little bit more, but their base rent maybe doesn't go up. That can add value to the property. So converting some of those leases that are not triple net into triple net is also part of the strategy.
And then what's the big picture? How long will you be acquiring these types of properties? And then at what point will you bundle them all up and sell them off to an institution or a REIT?
Our target period is between 6 and 8 years. And the reason for that is there's a couple of reasons. One is based on the lease term at most of these properties. So most of these tenants have leases from, say, 3 at the shortest. Some have shorter, but typically 3 is a short lease to maybe 7 years is a longer lease for these types of properties. So to have enough time to turn over pretty much every lease, do those renovations, get new tenants in place, and be at a point in the market where it's generally favorable to sell, we want to have that flexibility of up to 8 years. So it could be shorter. We could accomplish all that in 3 years, 4 years. It may be that's the right time to sell. That real estate market in general has heated up. Maybe interest rates have come down temporarily at that point, and that's the opportunistic time to sell. But part of the strategy is building in a kind of flexibility so that if we do need to hold it on longer because the market hasn't recovered or something negative has happened and we need some time to recover from that, to preserve property values and investment performance, we want to be able to do that too. So this is definitely different than a type of fix and flip or a short-term value add where we're saying we're going to do it in 2 years or we're going to do it in 3 years and then that's it. We see a longer-term hold period as both better for us in terms of operators and better for our investors because we have more options in terms of when we're actually going to monetize the assets.
What's the most challenging aspect of carrying out that plan that you just laid out?
I would say that the most challenging in some cases can be the finding the best managers, I think, in the local markets and finding ways to improve the operations. The physical aspects of the properties are not very complex. These are really simple buildings. They're single story, mechanicals generally on the roof. But the operational aspects, finding a property manager that really treats the tenants well and can kind of push rents and make the tenants feel like it's worthwhile because they're getting that value. I think that is actually the harder part than the physical renovations.
So it's the people part.
Yeah.
Tell our audience how they can find out more about you, get a hold of you, or direct them to any website that you'd like to share.
So our website is celinebrighthouse.com. And my email address is cameron@celinebrighthouse.com. So if you go to the website, you can learn more about what we're doing with unanchored strip centers, a little bit of investor education around strip centers specifically, but also real estate in general. We have a couple of investor education programs that are on the website available, as well as calendar links and others that you can subscribe to so that when we're giving a live presentation, you can come hear about it, either about what we're doing as a company or the kind of investor education that we're providing.
Celine Brighthouse, spell Celine, is it Selene?
Yes, that's correct.
Cameron, what's your favorite hack or app?
Frankly, it's probably the calculator app to be able to do quick, does this make sense? Does this not make sense? I would say that throughout the day, that's the one that I pull out first.
What's your back of the napkin calculation? What are you usually plugging in?
With these triple net leases, you generally know what the escalations are going to be for some time in the future. You know what your going in cap rate is. So the first is just, what is that escalation rate? What do I expect NOI to grow over that period, even if I didn't do anything? And what is my going in cap rate? So at a high level, what can I expect for an unlevered return? And if we're not getting above, say, 10 to 12% unlevered return, I don't even generally go into Excel to look at it further.
And the escalation rate, just for our audience, that's built into the lease. It's like, how much is your rent or lease rate going to rise each year? It could be 2%, 3%. Yes. Cameron, thanks for coming on the show today to talk about this. I mean, your ability to kind of look out at, where is the momentum going? Where is the big money coming from and where is it going to? And being able to link that up to the unanchored strip centers. Really interesting to hear you talk about that. And I really appreciate you coming on the show today to share it with us.
Well, you're welcome, Brian. I really enjoyed our conversation. Thanks again for having me.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. And remember to save the date for the Midwest Real Estate Investor Conference on April 24th and 25th of 2025 in Grand Rapids, Michigan. It's going to be an event you won't want to miss, packed with invaluable sessions and opportunities to connect with like-minded investors. Keep listening for more updates, and we look forward to seeing you there. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.